In Chapter 1, we got an overview of what we call the accounting cycle. We saw how we could measure and process and communicate financial information for a company. First, we took each business transaction and put it in a worksheet to show how the accounting equation changed because of the business transaction. And we were able to do that and keep balances all the way through as things changed in the accounting equation. And then at the end of the period, we took our ending balances and we were able to put them into the format of the financial statements so we could then communicate to investors, creditors, how our company did during the accounting period. Well, now in Chapter 2, we are going to go more in depth and we're going to look at the actual formal accounting process for how these things are done. We looked at a very simplistic way of looking at it in the last chapter. So when we did that worksheet, every column in the worksheet, cash, accounts receivable, supplies, accounts payable, so forth, every column is called an account. Okay? And an account is where we track what happened. We show the increases and decreases in that category, let's say. And we can also in the account keep track of what the balance is. So that's really what each column in this worksheet is. And we can see we were able to use this worksheet and we were able to track what happened with the business. So this worked. However, it's not practical because here this company, it only had 3 assets, right? It only had a handful of expenses. Companies have hundreds of accounts. So a worksheet isn't going to be a practical way for us to measure and process what happened in our business. What we're going to learn is also different is we were adding and subtracting plus and minus to the different columns when we had a business transaction. And instead of saying increase and decrease, accountants will say debit and credit. So that's something that we're going to learn in this chapter is the language of accounting. And instead of using a column in a worksheet, we're actually going to take a halfway step towards the formal accounting process. Okay? We are going to use what's called a T account to track what happens in a specific asset or liability or stockholders equity. And so we can see it's a T account, right? Because it's shaped like a T. And on top of the T, we put the name of the account. Okay. The left side of the T account is the debit. The right side is the credit side. Okay. And so when we look at a T account, okay, we are going to be putting amounts on either the debit or the credit side when there's a business transaction. Okay. And so in Chapter 1, we just worked our way down a column, plus and minus, and we found the balance every time. Well, when you use a T account, you'll put the increases and decreases on either the debit side or the credit side of the T. And then at any point in time, you can find the balance. The way you find the balance in a T account is you add up the debit side of the T, you add up the credit side of the T, and then you subtract the total. The total of the debits and the total of the credits gets subtracted, and that's the balance of the account. And you put the balance on the account on the side of the T that had a larger total. So we can see here, cash. Various transactions happened. We put 2 amounts on the debit side of the T that adds up to 100. The credit side of the T adds up to 23, 31, 33. Actually, I was wrong. 23 plus 9, 32, plus 2, 34. So 100 on the debit side, 34 on the credit side. We subtract 100 minus 34. The balance is then going to be 66, and the balance will go on the debit side of the T. So it'll have a balance of 66 in this situation. Okay. So the balance would be shown here, 66. And so every single column in that worksheet is a different account. And all of the accounts of a business put together are in the ledger. And so in the olden days, when everything was done by hand, the ledger would be a book. Okay? And in the book, you'd have a different spot in the book for every different type of account. Well, now we know everything's computerized, and so it's going to be a file or a page in a file. And you're going to have a list of all the account names. Okay? The first page is kind of like the index page of a book. That's what the chart of accounts is. It tells you what all the name of the accounts are. So when you're going to put something in an account, okay, you have to look for the specific name of the account. Maybe we're calling it machinery, maybe we're calling it equipment. That needs to be decided ahead of time. And so the chart of accounts will tell you what you're calling all of your different accounts. And your chart of accounts lists the accounts in a specific order. Okay, so we show our balance sheet accounts first, right? What are our balance sheet accounts? What did we show on the balance sheet, right? We show the accounting equation. So your assets, then your liabilities, then your stockholders' equity. Then we show our income statement accounts. Well, what do we show on an income statement? Revenue and expenses. So revenue expenses will come after your assets, liabilities, and stockholders' equity in your chart of accounts. And there's a standard numbering system that businesses use. So every account is going to be assigned a number. Okay? And you'll be able to look at an account number and know what type of account you're dealing with, because all of your asset accounts, the very first digit in the account number is going to be a 1. So you could have 2 numbers after it, you could have 3 digits after it, but if you see the very first account number as 1, you know you're dealing with an asset. The account number starts with a 2, we're dealing with a liability account. Stockholders' equity accounts have an account number that starts with a 3. Revenue account numbers start with a 4. Expense account numbers start with a 5. And so we have already learned what assets were back in chapter 1, right? These are the things that the company owns. But one thing we haven't mentioned is that your assets are going to be listed in the order of liquidity, right? And so sometimes I'll ask my students what liquidity is. Sometimes people know, sometimes people don't know. But if I say, hey, what's a liquidation sale? Everybody knows that. That's when they're trying to sell off everything they have, right? When they're going out of business. You're trying to turn everything into cash. That's what liquidity is how easily something turns into cash. So cash is already cash. So when you're listing your assets, you list cash first. Accounts receivable is going to turn into cash pretty quickly because you're probably going to collect on those account receivable within, say, 30 days, right? And then you're going to use up your supplies, your prepaid expenses are going to be used up pretty quickly as well. Things like land, building, those are going to be shown at the bottom of your assets because you're going to have those for a while. Our liability accounts, we know these are the debts of the corporation. Accounts payable is the most common one, right? When we buy something on account, right? Then we have an account payable. If we borrow money from the bank and sign a promissory note, we've got a note payable, right? But now we're going to learn about a new liability, and this one is kind of the oddball, the exception to the rule. It doesn't have the name payable in it. It's called unearned revenue. And an unearned revenue is when the customer pays us before we do a service. So they pay in advance of us doing the service. And so it's a liability because we owe services to the customer. Okay, it's not a revenue because we don't record revenue until we perform the services. So when we get the cash for work we're going to do next month, we got to show cash going up, our assets going up. We're going to also show our liabilities going up, and the specific liability is unearned revenue. We now owe services to a customer. So gift cards are an unearned revenue, right? If you buy a gift card, right, at the hair performer's place by me, they sell gift certificates, and so they're getting the money. They're not going to do the haircut until the person comes in with the gift certificate. So they owe haircuts to whoever has the gift certificate or gift card. And then our stockholders' equity. Okay. So our stockholders' equity, we said, is broken down into common stock and retained earnings. And actually, dividends is going to be considered a stockholders' equity account. So it's going to be listed in the chart of accounts along with common stock and retained earnings. And these are all going to have an account number that starts with a 3. And so we know revenue, when right now we're looking at service businesses. So this is what we record when we perform services. Expenses, right? These are the bills of the company. And here we can see a chart of accounts. And here we can see the numbering system. All of the assets have an account number 1, 2 for liabilities, 3 for stockholders' equity, 4 for revenue, 5 for expenses. So when we're recording changes in the accounting equation, these are the specific names of the things that we can use when we're showing the change. Now, it's really important to look at an account and know whether it's an asset, a liability, stockholders' equity, because the account classification tells us whether the account has a normal balance of debit or credit. And this is really important because every different type of account has been assigned either debit or credit as its normal balance. And this what makes it tricky is sometimes a debit is a plus, sometimes a debit is a minus. It depends on the type of the account. If the account has been assigned a normal balance of debit, that means that account increases with a debit. Now, if an account has been assigned a normal balance of credit, that means that account is going to increase with a credit. So this is why we have to learn our rules of debit and credit. So here's the way they've been assigned. If it's an asset, an expense, or a dividend, it's been assigned a normal balance of debit. Okay? Liabilities, common stock, retained earnings, revenue have been assigned a normal balance of credit. Okay? Somebody made up these rules. Actually, an Italian monk back in the 14th century made up these rules, and it all works. Everything fits together. So sometimes students don't think these rules make sense, but they all fit together. It's just like, why is A the first letter of the alphabet? Somebody decided it, and we've all gone with it. That's how these rules of debit and credit work. Somebody thought up this system, everybody uses it, and it all works. In the beginning, you're going to have to do a little work kind of getting used to these rules, but hopefully by the end of this chapter, you'll have a feel for it, and it'll just be automatic. I don't even have to think about it. So if we're increasing an account, we go in the same direction as the normal balance. So assets have a normal debit balance. That's what they've been assigned. So if an asset is increasing, you debit it. Liabilities have a normal credit balance. So if you're increasing liability, you credit it. Stockholders' equity has a credit balance. So again, if we're increasing it, we credit it. So one of my students told me that she remembered the word dead, right? D-E-A-D. Your debit balances are expenses, assets, and dividends. Debit, expenses, assets, and dividends. That's how she remembered it. And so if it's an expense, asset, or dividend and it's going up, you debit it. If it's going down, you credit it. All the other accounts have a normal balance of credit. If those accounts are going up, you credit them. If those accounts are going down, you debit them. Okay. So that's what we're saying here. If you're decreasing an account, you do the opposite of the normal balance. So if you remember the normal balance, that's the direction you go when it's increasing. When it's decreasing, you go the opposite. Okay. So here's our overall. We can see increase and normal balance are the same column. Decreases are the opposite. Okay. And then our accounts that usually only go up, dividends is pretty much only going up. You'll only putting amounts on the debit side of the dividends T. Revenue and expenses only go up. So if revenue is involved, you'll put it on the credit side of the T. If it's an expense being changed in the accounting equation, it goes on the debit side of the T.